Welcome to Manage Your Damn Money with Ben and Malcolm, where we trade in personal finance advice for entertaining conversations about money, and I'm open to any and all product suggestions that might help me regrow a strong hairline. Welcome to Manage Your Damn Money with Ben and Malcolm. Malcolm, this is another wonderful day here in the Washington, D.C. metro area. First day of spring, I guess, if it's above 70 degrees. I think that makes it spring.
I rode to the studio with my sunroof open, so I guess that confirms it. Right?
Indeed it does. Indeed it does. We want to remind people you're here on the place where we trade in personal finance advice for entertaining conversations about money. We want to remind folks you can listen to our show anytime you'd like on Apple Podcasts, SoundCloud, Stitcher, Google Play, and now Malcolm, Spotify. And there's something we need people to do. What is it?
We need them to go on and leave us a review. Let us know what you like, what you don't like. Put it out there for the public, and we actually do read every single review, so it'll help us improve the show too.
Absolutely, absolutely. And today's conversation at hand for this episode is actually a big one. We've been talking about it a lot. Just to tell you what we're going to be talking about today, the new tax law and what it means for you and me. Back in December, Congress passed a new tax bill, which now governs the taxes and how we pay taxes in the United States of America. So we're going to talk about that. But before we get into that, Malcolm, this was a big weekend that just passed by for a lot of people.
Yeah.
A big film was released. It was called Black Panther.
So far, the number 5 released movie. Weekend box office tallies are still being counted, but
It was number 5?
number 5 globally all time.
Wow. It was like 400 million, I think, right?
It's touched 5 already.
Wow.
500 million. So
Okay.
this for me, so I saw it Thursday of last week, and this for me was up there with Dark Knight
Wow.
and Iron Man.
That's high
Which
are
are
praise.
like 2 of my favorite, not just action movies, but like 2 of my favorite movies, period.
Right.
So I get why it's getting like such critical acclaim.
Right. Absolutely. Those are movies you always watch when they come on reruns on
Right.
TBS.
You don't care how often it comes on, what
Right.
time of day it's on, that it's on TBS, and
Right.
you know there's going to be commercials. You got to watch it.
Absolutely, yeah. I saw it and I was pretty impressed. I went in with no expectations because I saw the movie I think on Saturday. But it was an excellent film. I thought it was entertaining. It wasn't what
How did you not have any expectations?
I just went in just
Social
like,
media has been hyping this thing up for the last like 2 months.
Uh-huh.
Ever since I think I saw the first trailer like during an NFL playoff game or something. And
Yeah.
like
From then on.
expectations have been crazy.
Yeah, I just went in there with a clean slate. And,
Okay.
I think they did a good job of meeting whatever I thought I was going to get or wasn't going to get. But anyway, as we do on every show, it is now time for headline. This is an interesting headline. You were the one who sent this to me, Malcolm. It is the most outrageous tax deductions of 2018. This was a February 2018 article by Michael Cohn of financialplanning.com, which shares some of the most ridiculous attempts at tax deductions reported by a group called the Minnesota Society of CPAs. It was a recent survey of their members. The first one, Malcolm, I thought this was pretty funny. It was the first one on the list. A tummy tuck. A client wanted to list the fat reductions on their abdomen procedure as a medical expense.
Right.
So that's pretty hilarious.
Especially since your health insurance wouldn't cover it. So why would the IRS deem it appropriate to be able to write off? But yeah, I thought that was pretty funny too.
Absolutely. Then another one was building a dream home. A contractor and a client tried to make a case of counting their building of a new home for themselves as a personal or business expense. So they were like, I'm a contractor, I build homes, I'm gonna build myself a home, and then I'm gonna use it as a business expense, which
Right.
is ridiculous because that's not how it works. Then another one, lunch. A client tried to claim mileage for round trips to lunches at restaurants by himself.
That might be my favorite one on this whole list.
Why is that?
I'm eating by myself, and that should be tax deductible.
Mm-hmm.
And the mileage that I drove to go to Panera Bread to get that sandwich. Like, how is that even, like, how does that cross your mind? But at the same time, like, there's something to be said for the audacity.
For giving it a try?
Why not?
That's funny. Indeed, indeed. Another one was a working vacation. A client wanted to write off a family trip to Disneyland because he, quote unquote worked the entire time, which is clearly not how it works when you're on vacation. You can't claim to have worked and be at Disneyland. And
even if you did, so that's a waste. Like, he probably got yelled at the entire time from his kids and his spouse. And then
Definitely
missed the vacation that he paid for,
right?
And then worked the entire time,
right?
So, and then you don't get the tax deduction,
right? Absolutely. Another one on the list was a boat. We always hear of the boat write-off. This person occasionally took clients on the boat, so wanted to be able to write off at least a certain amount of the boat. And I think a boat is like a full leisure thing, so I don't know if that could be written off.
I don't know. I might have tried that one too. If I somehow find myself in the tax bracket to ever own a boat leisurely, right? Why not? It's my home office now. Like,
Actually, I live and work off my boat because I'm a millennial.
There
and
you
that's
go.
how it works. Right?
I can't afford rent in D.C., so I live on this boat.
Right, in the Potomac River. Also, a pool. A client wanted to write off repairs on their pool as part of their quote-unquote home office reductions, which is ridiculous. All I can think of is like somebody on a floaty with a drink in their hand.
Yeah, the IRS is coming for that pool, too.
Absolutely. And then money given to family members, they'll consider it. This is not considered a charitable gift. So you can't, write off money you've given to Uncle Rooney because he needs to pay his light bill. And then the last one on the list, this was interesting, a gambling loss of $2. A client wanted to deduct a $2 gambling loss on a sporting event, but I didn't know this. You can apparently deduct losses from gambling on your taxes in some kind of way.
If it's your profession.
If it's your profession.
So like the folks you see on ESPN playing poker, like for $2 million, $5 million is the stakes of those guys can write off what it cost them to get into it.
Okay.
But not folks like you and me just sitting here playing a game of spades and I lost $2 to you. Or the Super Bowl that just passed,
right.
I bet you $2 and a beer, and now I can write off the $2. That doesn't work.
Right. So real quick, what's been your understanding of what you can and can't deduct? Like, I feel like that's still evolving for me. Like I feel like some of this stuff is new information in terms of what you can and cannot deduct. How do you make determinations in terms of what you're quote unquote deducting if you have a business or if you have like expenses from work or whatever?
But that's kind of the reason, and this might be getting a little too far ahead, so I'll back it up a little bit, but that's kind of the reason why you would hire somebody who knows this kind of stuff, right? Like, if you don't know if you genuinely don't know if your pool is a legitimate write-off for your house, right? I'm being extreme, but it was in the write-up.
Right.
Then hire somebody who would know,
right.
And then actually take that person's advice. Don't just go out there and say, I'm going to take my chances and see what the IRS comes up with. Right. They gonna find you, homeboy. In the words of Anton Dotson.
They gonna find you. They gonna find you. What about if you can't afford to hire somebody?
I don't know. I mean, there's the TurboTaxes and the other online folks and the people you see at Walmart when you. I don't want somebody at Walmart doing my taxes. I come to you because you're a discount retailer. Right. What am I giving up in lieu of good tax advice? Right. You know what I mean? So I don't. I pony up the cash.
I find that trial and error also works.
If you say so.
In that I've had different and varying tax scenarios personally, and you do it and you remember what you did or take notes on what you did, and then you try to iterate to a better version of it the next time. And trust me, I've been sent bills and things from the IRS. They don't miss anything.
That's what I'm saying.
And so you make sure you keep a record of what you've done so that if you've made mistakes, you can make adjustments. But you can also, as Malcolm said, save to, have a tax professional at the time when it's time to do taxes. But real quick, when do people know, Malcolm, before we go to break, when it's time to get a tax professional, like graduate from the online tax preparation situations to tax professional who's paid to do this?
I think you just hit on it. When you start getting notices back from the IRS saying what you did back in 2014 wasn't it.
Right.
Come talk to us. Well, then it's time to enlist the services of somebody who does this all day, every day, because it's obvious that it's gotten beyond. Which is actually when I started working with a tax professional. Like I said, that first notice was it. Like I think I ended up having to pay like an extra $500 or something. And I was like, I missed this.
Right.
I thought I had it under control. Right. Obviously, I don't.
Right.
Let me pay somebody half of what the penalty would have been to get it right the first time.
Absolutely, absolutely. And we actually have a tax professional who came on our show last year, so scroll through our episodes on the different platforms. Apple Podcasts. We're now on Spotify, so that's a big thing. Google Play, Apple Podcast, and SoundCloud. You don't know which other ones?
I'm just in awe that you got that plug in there so smoothly. So
Indeed. But we want to remind you, you are listening and watching Manage Your Damn Money with Ben and Malcolm. We're going to take a quick music break, but when we come back, the conversation at hand, the new tax law and what it means for you and me. We'll be right back after this music break. Welcome back to Manage Your Damn Money with Ben and Malcolm. This episode's conversation at hand, the new tax law and what it means for you and me. In December 2017, Malcolm, the United States of America was granted new legislation called Tax Cuts and Jobs Act, which will govern our taxation structure until 2026. The tax law has already taken effect, changing income and tax implications for all of us. On this episode of Manage Your Damn Money, we will take a deep dive into what this tax plan does for you and for me, explore broader societal level implications, and talk about what people can infer about those in power through this new tax plan and recently released presidential budget priorities, Malcolm. So this was like a big deal at the end of 2017. Both the House and the Senate of the branches of government were working on a new law to kind of govern our taxes. Explain to me like what you knew kind of going in before you actually saw the bill once it was passed as a law on the other side.
Well, I probably knew the bones of this thing for a while now because Paul Ryan's been working on this since he got out of college. Like this has been like his greatest feat ever.
Right.
Because this manifesto was written in the 90s. But so I mean it's been cropping up every time they run a new Republican candidate who runs on I'm going to reform taxes. But the key thing in this you touched on is that the personal side of it expires presumably in 2026.
Right.
But it's like so loosely fit in there that I found out after it passed, it could actually be repealed by the next administration.
Right.
So we could be talking about a case where it's much ado about nothing because 1 year, 2 years, we get the break, and then all of a sudden, poof.
They've changed it. Indeed. It was interesting because when I actually, a lot of this stuff nowadays, especially in the era that we're in, everything's kind of placed through a political lens. Mm-hmm. And so when I actually saw what was in the law, I was kind of pleasantly surprised by some of the things. Like, oh, that sounds like it's good for me.
Right.
So I think it was interesting to kind of understand like what you read and the news that you see sometimes doesn't necessarily represent what's actually in the bill. But
Well, it's also that side. I can't speak for you, but it's also that side of me that doesn't want to give Donald Trump credit for it. Right? Like, there's also that side that's like,
Right.
I'll take the tax break, but you know, I haven't forgotten about all the other stuff, dude.
but I don't like it. Right. So anyway, the Trump's tax plan and how it affects you. The story we pulled for this was a February 2018 article by Kimberly Amadeo on thebalance.com, which covers the basics for individuals when it comes to the new tax plan. Here's a rundown. This is actually a very cool piece because it kind of very well set basically the different things that have changed. The cuts to the corporate tax rate. There were cuts to the corporate tax rate from 35% to 21%. And then there was the top individual income tax rate, which was lowered from like 39.5, I think, to 37%. And then there were some other changes in the tax code. The only people that didn't get a tax break, so to speak, were those making under like $9,500, which is like, really that's.
They're rebating back all your taxes anyway.
Right. So there was that remained at 10%, but every other bracket got some kind of reduction. The new tax bracket graphic we had up on the screen at one point, but the lowest tax rate now is 10%, while the highest is now 37%, as I mentioned. Trump's tax plan doubles the standard deduction. A single filer's deduction increases from $6,300 to $12,000, which is crazy. And then the deduction for married and joint filers increases from $12,700 to $24,000, which is a huge jump in terms of what you're able to deduct.
Right.
And the standard deduction. So that means you just mark that one little box and you get that deduction off top.
So that was probably the biggest component of this whole thing that I feel like personally affects me.
Sure.
So where you were talking about the need to work with a tax professional, an accountant of some sort, all of the receipt collecting,
Right.
all the, recording of every move you make and all that kind of stuff, it becomes a little null and void at the point where the standard deduction was doubled.
Right.
Because now I don't have to worry so much about keeping track of all of those things.
And you probably won't make expenses that are above that
So
threshold.
above 6,000?
Right.
Yes. Above 12,000, now I've got to do double the damage
Right.
with the same amount of income roughly. It's a little bit tougher to do.
Absolutely. So you would take the standard deduction. And
In
then
a heartbeat.
Absolutely. And it also eliminates personal exemptions, which is an interesting change. The act also limits the deduction on mortgage interest to the first $750,000 of a loan. So that means like if your house is worth more than $750,000, you won't be able to deduct that amount above that point.
Which is interesting because if you're listening to this or you're watching any other channel and you hear $750,000 is the most mortgage I can deduct, you're like, oh, boo-hoo, who has a house that expensive?
Right.
But for the folks in this area, New York,
It's
San
possible.
Francisco, you look at it and go, oh my God, how am I going, so it's perspective.
For sure. And then also interest on home equity lines of credit can no longer be deducted. So people taking, equity out on their home, whatever equity actually is no longer something you can deduct. And current mortgage holders aren't affected. So this is for new. This is all in set in stone for those who are now new homeowners who just recently got into homes or just getting into homes after the enacting of the law. And then taxpayers can deduct up to $10,000 in state and local taxes. However, they must choose between property taxes and income or sales taxes. This will harm taxpayers in high state tax places like New York and California. And the law also expands allowable deductions for medical expenses. And this is where I was like, oh, wow, like this plan has a heart, and I didn't even know it. The law also expands allowable deductions for medical expenses, but also eliminates the Obamacare tax, which charged people if they went without health insurance, which was a big deal back when Obamacare or the Affordable Care Act was getting pushed through. This is likely to raise the cost of health care overall. The act also doubles the estate tax exemption to 11.2 million for singles and 22.4 million for couples, which means wealthy people are getting taxed less when somebody dies and they want to transfer the money over.
Which is Trump's manifesto.
Right. And
He's been talking about that since college. So, you got a lot of people that have had these vendettas for a long time that are finally getting to see it to fruition.
Absolutely. And then also a little bit about kids. The act increases the child tax credit from $1,000 to $2,000. And I'm like, wait a minute. They care over there? Like, wait a minute. That's what I'm reading here.
Surprisingly, that was like snuck in there at the 11th hour by Marco Rubio, of all people. Like, I was very much surprised.
Again, when I read this story, I was very shocked. I was like, I thought it was supposed to be bad things in here. Like, they come and knock on your door to take the money from your kid's allowance or something like that. Like,
we haven't yet. Every economist on CNBC, on Bloomberg, and everywhere else with an opinion is still debating what the effects of this whole thing is going to be on the average, ordinary person like us versus the major corporations that have all of the money.
Right.
It's yet to be seen. Unfortunately, economics is one of those things where you get paid to pontificate on what's going to happen in the future, but realistically, you don't really know until all of us find out together.
Right.
So we'll see what the major effects will ultimately end up being. But in the short term, reading this, it does look like,
Right. There's a break for the little guy in a little bit. And we encourage people to read it. That piece is actually available. We posted it on our Facebook page, facebook.com/ManageYourDamnMoney, and you can find it there. Just scroll down. And then another thing that I wanted to ask you, Malcolm, before we go to break, was there anything in here that you were surprised by where people would find help for their own personal situation that you were like so shocked to kind of see it in this bill?
So interestingly enough, I'm in a group chat with a bunch of my friends from college. And so, you're talking about folks who are college educated, probably command a little bit more than the minimum wage that's recently been increased, right?
Right.
And everybody's talking about how they saw their paycheck go up, even if only fractionally, in February when the tax cuts actually took effect.
Right.
And it was interesting because as I'm looking at this conversation, I'm thinking to myself, none of you were the intended target for this whole scenario. Right. Or like, I was watching a Dave Chappelle stand-up that he did the other day when he's like, all these folks that are out at the rallies that are like, it's going to be great for us. The tax changes are going to be great for us. He's like, no. This is for me. I'm the guy who's going to benefit from this, not you. And that's essentially what it boiled down to. Like the folks who are kind of on the lower end of these tax brackets aren't going to see a positive effect, if not negative.
Right.
But that's usually where the noise comes from and the celebration. And it's really the folks in the middle who ended up, making out a little bit better. So,
and that's definitely true, Malcolm. We're going to take a quick music break, but when we come back, we're going to do Malcolm's Money Minute. We want to remind people you can always listen to past episodes of Manage Your Damn Money on Apple Podcasts, SoundCloud, Stitcher, Google Play, and now newly Spotify. Also, if you have a question that you want to send to us, send it to us at info@manageyourdamnmoney.com. Malcolm will answer your question on his Money Minute if you so choose, and if you have any other comments or suggestions, please send it there as well. And we want to remind you, leave us reviews on all of these podcast platforms. Let us know what you're thinking and how we're doing. We want to remind people this is Manage Your Damn Money with Ben and Malcolm. We will be right back.
Thinking of taking a loan from your 401k balance? Well, here's a few things to consider before you contact your human resources department. It can be very attractive, the thought of taking a loan and paying yourself back over time. Experts will also tell you that your 401k balance is a less expensive way to borrow money because the interest rate charged is generally lower than the rates on traditional loans from banks. But despite these claims, borrowing from your 401k goes against almost every time-tested principle of long-term investing. For instance, some plans have a provision that if you borrow from your 401k, you're prohibited from making additional contributions until the loan balance is repaid. Plus, there's also the fact that you're paying your loan back with after-tax money, so you're negating one of the biggest advantages of having a 401k in the first place, which is its tax deferral. So, if the idea of taking a loan from your 401k plan crosses your mind, remember, you're likely shortchanging your future to finance your lifestyle today. Instead, consider scaling back on your current expenses in order to reduce the burden on your wallet. I'm Malcolm Ethridge, licensed financial advisor, and this has been your Money Minute.
Excellent Money Minute there, Malcolm. Of course, if you have a question you want Malcolm to answer, send it to us at info@manageyourdamnmoney.com. Today's conversation at hand for this episode of Manage Your Damn Money, the new tax law and what it means for you and me. The tax law is rather sterile stuff, but it's also important to understand the expected and or possible implications, as you mentioned, Malcolm, of such a law. Individuals, first of all, dealing with individuals, Malcolm, what's good and what's bad? Higher deductions, which is good for an individual, higher take-home pay, at least until 2026 or until they change the law, which is also a possibility if like administration and who has control of what changes over. But then there's also the other element, which is maybe somewhat rooted sometimes in a little bit more of the political side of the debate. There's like these social ills that might come as a result of taxes. Number one, economically speaking, we don't necessarily know what the full impact is. So, for example, the lowest tax rate of 10%, they got zero tax break, technically. Now, as you said, they get most of their money rebated to them anyway. But some would say this means people making less than $9,500 a year are shouldering a slightly higher percentage of the national tax burden, which is in terms of like morals and values. Should the poorest be like, why didn't the poorest get a tax cut from 10% to 8%?
Well, they did in a sense because you heard all these different corporations announcing that basically they're going to pay their employees what they should have been paying them all along. So you hear these major corporations that have 50,000 employees, 100,000 employees saying, oh, we're going to implement our own $15 baseline of minimum wage for everybody. Well, if I'm somebody who lives in Kansas, that's awesome. I just got a significant raise. If I live in California, I should have been getting paid more than that already based on the cost of living difference from where I am to Topeka, Kansas. So basically all you did was take the tax break that you got from the federal government as a corporation and sprinkle a little bit on me and keep the rest for yourself, where basically, you know, it's great headlines. It sounds good, and it makes me walk into work tomorrow morning or my union meeting tomorrow morning and go, oh, man, they're looking out for the little guy. And then when I spend that too, 2 months from now, I'm like, I'm back in the same place I was. Like nothing really has changed.
Absolutely. That's another interesting question of whether it helps society or hurts society. That's a good question. Also, the estate tax was effectively lowered for allowing very wealthy people, like the president, the ability to transfer more of their wealth, possibly contributing to greater consolidation of wealth across the so-called 1%. So that's a big deal, especially when it comes to kind of like the more political discussions, whether or not we should just allow wealth to continue to concentrate. And this piece of the law, as we mentioned, allows that to happen a little bit more effectively without the government taking a greater share of that.
I don't even know if we still have a 1%.
What is it?
I think we probably have like a quarter of a 1% problem at this point. Like, so here's an example that I'll give you. The 6 largest banks in the world, domiciled here in the United States, have upwards of an 80% market share of all of the assets held on deposit at banks.
Wow.
So your money, my money, everybody in this studio, everybody listening to this podcast, 6 banks own 80% of the market share right now.
Wow.
They can pretty much do whatever they want.
Absolutely.
So when you look at the concentration of power that goes along with the concentration of wealth, who's going to benefit from those tax cuts?
Right.
Those 6 banks,
Absolutely.
right? So then it makes it even tougher for the folks you're talking about who make $9,000 a year and even $90,000 a year in some instances to really do anything differently tomorrow than what they were able to do today.
Right.
Because at the same pace that, you're kind of climbing the ladder, so to speak, you got folks building a whole new ladder right next to you. So
Right.
I am a little bit nervous, to your point, for what the impacts will be ultimately on society.
Right.
Significantly in that concentration of wealth and power conversation right there. But who am I?
Another one. Yeah, who are we indeed? But another potential ill or good, depending upon where you stand. You might be happy or sad about the reduction in government programs and public spending. Everything from safety net programs and public assistance to government offices like the Department of Justice are funded by U.S. tax dollars. A reduction in revenue usually means, or it's supposed to mean, a reduction in government spending. That's not actually always happening, but that's something that happens where if you're spending less on government programs, you won't necessarily get the same services that you're used to. Also, corporations, what's good, what's bad? Potential good. The tax plan reduces corporate taxes such that large corporations are encouraged to move cash and assets back to the states, creating the potential to create additional jobs. There was an example, Malcolm, that I'm sure you're aware of, where Apple is bringing back money, and they're going to be I think they're going to have 50,000 extra jobs now as a result.
Allegedly.
So they say.
And then Carrier plant in Indiana was also, creating I don't know how many hundreds of jobs, and folks got laid off as soon as Mike Pence left. So we'll see. As you can tell, I am just as skeptical as always of announcements like this and, press conferences that are geared toward distracting me with the left hand so you can do something different with the right hand. So
Indeed. Corporations will pay a one-time 8 to 18% tax, I believe, on money brought back into the state. So people hold money over states, or corporations hold money overseas, so they don't have to pay taxes on it immediately. And this was a moment where they can bring it back with a reduced tax burden for that money.
See, that one I think will have some positive impact on our individual lives, probably not me and you specifically, because unfortunately we live in one of the highest cost of living areas, period.
Right.
But what I'm getting at is by having that repatriation holiday that they're calling it,
right,
it allows places like Amazon, for example, to bring additional dollars here that they've been hiding out in Belgium somewhere or wherever.
Right.
Build a new fulfillment center that employs 20,000 additional people who were working at a place that'll pay them half as much as what Amazon will.
Right.
And so then that helps the local economy. It helps bring in things like smart cities and, all that kind of stuff.
Right.
Here, not so much. So I'm still, I'm sliding this in there. I'm still hoping Amazon doesn't show up in our backyard with this second location that they're working on. But I do think that repatriation holiday goes a little ways to help improve things like that. Also, infrastructure spending.
Right.
So if I'm a cell phone carrier, for example, I won't mention the one that I have by name because I'm about to trash them. Their service is pretty terrible.
Right.
But having the ability to bring additional billions of dollars from overseas somewhere hopefully allows them to
invest in your service.
Invest in that service, get those antennas perked up a little bit better so that I don't lose service just because I'm driving between 2.5 trees.
Right.
So we'll see.
Absolutely. We want to remind people you're listening and watching Manage Your Damn Money with Ben and Malcolm. We're talking about how the new tax bill has impacted us as individuals. Another potential ill, it's the flip side of what you just said in terms of money coming back, making more jobs. It could just make more money for the people who already got the money.
Oh, that's going to happen regardless.
That's built in.
I am 100% confident that is going to happen regardless. The thing that I'm most concerned about, though, in all seriousness, who is going to pay for this?
Yeah.
We're talking about $1.5 trillion now in tax cuts spread across an 8-year period. Who is going to come up with that money? Right. We're already talking about a generation that's $1.5 trillion in debt to pay for school, right? Underemployed, if not unemployed, underhoused, if not, basement housed. I'm making up terms here, but you get where I'm going. Who is effectively going to pay for this? Not your 95-year-old congressperson who put this thing in effect, got their kickback, and they're going to ride off into the sunset one way or another. that gets back at the case that I make to you all the time about why there needs to be age limits on folks who make the laws in this country, because at 80 years old, you're sitting up there going, well, I did raise the debt $1.5 trillion, but
You can't talk like that, Malcolm. That DJ Khaled always talks about are gonna show up at the studio and they're gonna take you somewhere. We're never gonna see you again.
They came and got me a long time ago, so I'm okay.
Indeed. And then another thing that's interesting, because not too long ago, a couple of weeks ago at this point, the Trump administration released their budget priorities for 2018. And every presidential administration has to release every year a big old thick book about this big, which essentially lists how they're going to spend all the money that they get in tax revenue. And it's supposed to be that taxes line up with the budget priorities and things fund what, the two are connected. In the world we live in, that's not the case. But at the very least, recently, their release of their 2019 budget proposal allowed us to see what some of the priorities were for this particular president and their administration. Some of the numbers that were there, some of the increases in spending from this particular budget was the Veterans Affairs Department, Department of Defense, Homeland Security, Human Health Services, Commerce, Energy, and the Justice Department. They all got varying levels of increases in spending. But then, of course, like we talk about cuts, because we got tax cuts, there has to be reductions in spending. We got 25% cuts for the EPA, which is the Environmental Protection Agency, and we know Trump administration doesn't like that.
Right.
Then the SBA, or the Small Business Administration, got a 25% reduction in money to be spent, and that's the Small Business Administration, so 25% cut to that in this particular budget. State Department got a reduction of 23%, Transportation got 18% reduction, Agriculture 15%, and so on and so forth. So people got, at least these arms of government and these branches of government which are funded by tax dollars would theoretically have huge cuts as a result from a budget if it was actually enacted.
Fortunately, everything you just said is preliminary, though.
Right, yeah.
It hasn't actually been voted on.
Right, and the last budget that was passed was a very long time ago at this point. An actual budget, it has to be passed by both branches of Congress, and then has to be signed by the president, and that hasn't happened in a very long time. So real quick, Malcolm, before we close the show, do you think people care about reduction or raise in their taxes as it pertains to all these government activities? Like, do people make that correlation?
Unfortunately, I think people tend to have a propensity to be very short-sighted.
Okay.
So we're distracted by, look at the extra $100 a paycheck that I now get because of these tax cuts.
Sure.
And so, what can I do with that extra $2,400 that's going to come to me every year?
Right.
Not a lot. Inflation is a real thing, so
Indeed.
Not much. But at the same time, that $2,400 you just got in your pocket is going to have to come from somewhere. That's that $1.5 trillion I was harping on earlier.
Right.
What I'm afraid, and this is going to be me being the dark cloud again, what I'm afraid is going to ultimately end up happening is that has to come out of the Social Security system that you and I have been paying into by the time it's time for us to retire, 40 plus years.
Right.
And now it's going to be a thing where it's like, I know I promised you, when it comes time for you to retire, I got you. But it's not there, and then all of a sudden, the United States is Bernie Madoffed an entire generation.
Wow.
With this thing called Social Security, because that's where the money that's the biggest pool of money that you can pull from to pay for things like these daggone tax cuts that increase the deficit. So
absolutely. Another interesting thought: the United Kingdom and places in Europe, in particular, have very high taxes, but have a trade-off in having more government programming. They have free health care, they have free college, things that people don't have to pay for. What do people have to remember in these debates about taxes and what's fair and what's not as it pertains to the big picture? You just talked about us being short-sighted and not really seeing the impact down the line. What do people have to remember broadly about taxes and when we talk about
it's easy
cuts?
to look at other countries and say, oh my God, look at them. They have such a sophisticated system. And everybody walks into the hospital and gets care, and everybody's kid is entitled to a free education and blah, 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 blah. But if I tried to impose a 50% tax on you in exchange for that, you'd be ready to fight me,
Absolutely.
right? Physically, you'd be ready to do me harm. So we've got to be a little more realistic about what we're willing to trade off for, I personally would much rather pay the taxes and have good things.
Right.
So I'm more concerned about oversight and penalties being in place for misappropriation of my tax dollars. Then I'm cool. I don't mind paying for underprivileged kids to have school books, right? Those are things people should generally have when they go to school.
Right.
I'm okay with that.
Right.
Clean drinking water, roads to drive on. But don't waste my money on, the health secretary wanting to fly private all across the country because, folks sitting next to me in the seat got cooties. So I need, that kind of stuff I'm not cool with my tax money going to, and that's why I have an issue. But folks saying, oh, well, they have free health care in Canada, and I'm going to move to Canada. Okay. Yeah. And I'm going to move to Wakanda.
And on that note, King T'Challa, we want to thank you for listening and watching Manage Your Damn Money with Ben and Malcolm. This is another great episode, Malcolm. We want to, of course, thank our friends here at Montgomery Community Media and the crew for doing another great show. Of course, you can listen to past episodes of MYDM on Apple Podcasts, SoundCloud, Stitcher, Google Play, and now Spotify. Simply search Manage Your Damn Money. And remember, leave us a review. That helps us go up in the ratings. And we need you to tell us how we're doing. If you have a question, concern, or comment, send it to us. info@manageyourdamnmoney.com. And you can also catch us on our social media handles. What's yours, Malcolm?
At Malcolm on Money.
And of course, mine is at MYDM1. And you can catch us on Facebook, facebook.com/manageyourdamnmoney. And we're always on our website, manageyourdamnmoney.com. We appreciate you spending some time with us. Until next time, be good with your money.
Peace.
Peace.